You might be thinking that the whole world is about to collapse. You see news outlets talking about the recession and thousands of stocks and investments in nosediving. I'm here to tell you that it might not be so bad. Today, I'm going to show you exactly why the recession is a great time to invest. How could you get started and what things you need to focus on before investing money? Watch the complete video to get information. The recession can be an ugly thing. When the economy is in trouble, asset prices frequently fall, costing investors tens of thousands or even hundreds or millions of dollars. We can see this happening right now in our economy. The S&P 500 is down 25% below its January peak, Amazon over 32%, and Tesla stock dropping over 35%. While these numbers look dangerous to some, others may look at this and jump for joy. That's because they can buy assets at a discount and then sell them later when the economy recovers and asset prices go back up. Make sure to subscribe to our channel and hit the bell icon for more interesting videos. So let's begin the video. So, why should you invest in it? Or what opportunities you have? So the first point is, you can get discounted prices. One of the biggest advantages of investing during a recession is that you can get discounted prices. When the stock market is down, many stocks are selling at bargain prices. This gives you the chance to buy shares at a lower price and then sell them when the market recovers for a profit. Going back to the example earlier, looking at the S&P 500 is down 25% from the peak at the time of making this video. Well, a proper investor would look at this and say that it is on a discount for 25% off. This can be applied to other stocks or investments too. The second point, which is closely connected to the first point, is there are more investment opportunities. When there is a terrible news, there is a lot of fear, and prices start dropping. Many investors leave the market at the wrong moment due to recessionary anxiety. If a lot of people are overly afraid of something, opportunities may arise. Opportunities that are reflected in returns for investors. You can see this with thousands of new millionaires that popped up during the COVID pandemic, but you wished you jumped in when everyone was running away. Number 3 is, you can reduce risk. Investing during a recession can also help you reduce risk. Finding cheap stocks that have the potential to rise in value is simpler when the stock market is down. As a result, you may be able to profit without taking on as much as risk as you could if you invested in a market that is seeing growth. While there are opportunities all around us during a recession, there's a few things you need to keep in mind while investing. Like number 1, look for bargains. As was already discussed, finding deals while investing during a recession is one of the finest things you can do. Find undervalued assets and then purchase them while they're cheap. An example of this would be the energy sector. Back in 2020, the average return of the energy sector was just under 33%. Now in October 2022, the energy sector is one of the best sectors to invest in, giving a whopping 52% year to date. Number 2, consider buying defensive assets. People tend to spend less money during a recession, which can affect firms that depend on consumer spending. As a result, you might want to think about investing in defensive assets like government bonds or necessities stocks. These protective asset classes have given investors a better diversified portfolio while also helping to counteract stock market dips. Defensive investments typically maintain or even improve in value when traditional stock prices decline, as recently shown with Exxon's year-to-date gain of more than 35%. Number 4, don't invest all your money at once. Your assets should be diversified according to majority of financial experts. Purchase some bonds, various equities, and perhaps keep part of your investment in cash. By doing this, you can avoid investing your whole savings in a single venture. This teaching can also be applied on how long you decide to invest your money. You run the danger of purchasing just when the market is peaking if you invest it all at once. A significant loss of your investment might result, for instance, if you had purchased equities towards the end of 2007. You wouldn't make that loss up for many years. Number 5, have a long-term outlook. Bear markets may be unexpected, and it's difficult to estimate how long it will take for stock prices to start rising again. The good news is that right now is among the most profitable periods to purchase. Although it can take months or even years, the market will eventually recover. You run the risk of seeing a decline in your assets in the near term. However, the likelihood of positive average returns over the long term is far higher. Buffett advises taking a long-term approach to investing. I can't predict the short-term movements of the stock market, he writes. What is likely, however, is that the market will move higher, perhaps substantially so, well before either economy or sentiment turns up. Investors should focus on fundamentals rather than forecasts. Investors should focus on business fundamentals to make long-term investments. Rather than worrying about where the economy may go, one example of a company with solid financials and a path to more growth is AbbVie, NYSEABBV. AbbVie's acquisition of Botox maker Allergan has diversified its business. Botox cosmetic sales rose 19% in its most recent quarter. Another stock with strong fundamentals to consider is Adobe, Nasdaq ADBE. The tech company recently nosedived after announcing lackluster earnings numbers where sales rose by 13% to $4.4 billion. What are the best investments to make in a recession? When the economy is struggling, a lot of investors look to defensive stocks, dividend stocks, and value companies as promising investment options. However, individuals wishing to invest during a recession may also find bonds and ETFs to be wise alternatives. The key is to focus your attention on making investments in businesses with solid core business fundamentals. Organizations that, for example, have strong financials, a capable leadership team, and a competitive edge are far more likely to endure instability. A defensive stock is an investment that performs comparatively steadily regardless of the situation of the economy at the time. Typically, stocks in consumer staples, healthcare, and utility industries, these businesses often have minimal market volatility and are less susceptible to the effects of changing economic conditions. Due to the expectation that defensive stocks would do well despite the economic slump, investors typically add them to their portfolios. Dividend stocks pays dividends based on their established profits monthly, quarterly, or annually just by owning their stocks. Companies that pay dividends tend to be stable, profit-earning companies looking to make their stock a more attractive investment. Coca-Cola and Johnson & Johnson are just some of these dividend kings that have paid dividends for over 20 years. Value stocks are companies that investors believe are underperforming on the stock market. They may be worth more than the market currently reflects and offer financial opportunities during a recession. Bonds are fixed income assets that reflect loans from investors to borrowers, typically corporate or governmental. A bond may be compared to an agreement outlining the terms of the loan and the associated payments between the lender and the borrower. An example of this would be that if I have $100 and the government wants to buy my $100 off me and promises to give me a 5% return. After a year, the government gives my money back with the addition of $5 from the return. ETFs are collections of stocks or bonds pooled together. They offer diversification and can be less risky than investing in a single stock. The most well-known ETF would be the S&P 500. When choosing the best investment for a recession, it is important to consider your financial goals and risk tolerance. Defensive stocks, dividend stocks, value stocks, bonds, and ETFs can all be good choices for those looking to invest during an economic downturn. Why it's important to dollar cost average and some statistics as to how it outperforms other strategies. Dollar cost averaging is one of the most important investing strategies to understand. It describes making regular, fixed amount investments in a security or series of securities. The danger of purchasing at a high price and selling at a low price is decreased by this method, which smooths out the impact of price swings. Over time, it has been demonstrated that dollar cost averaging outperforms alternative investment tactics like attempting to time the market. The effectiveness of dollar cost averaging can be explained by a variety of factors. It first eliminates emotion from the situation. It may be tempting to increase investments during periods of rising prices in an effort to maximize returns. This, however, frequently results in buying at the highest prices and selling them when they decline, losing the opportunity to realize significant gains. By investing the same sum of money at regular periods regardless of the state of the market, it removes the element of emotion from investment. Secondly, it encourages you to purchase more units during periods of low prices and less units during periods of high prices. As a result, your average purchase price will decline over time and your earnings will rise. Thirdly, it lessens the risk associated with buying only one security or item. Spreading your investment over several securities lowers the likelihood that you will lose everything if one of them crashes. Understanding this method is crucial for all investors. By taking emotion out of the decision-making process and benefiting from market swings, it can help you generate more steady income. When considering dollar cost averaging as an investment strategy, it is important to first set goals. What are you trying to achieve with your investments? Perhaps a better question to ask is this: are you more afraid of losing money in the short run, or more afraid of missing out on an opportunity to make money in the long run? If your portfolio reflects an outlook of 5 years or longer, your bigger danger isn't being in the market when things are a little rough. It's not being in the market once things finally take a turn for the better. Are you looking to simply grow your wealth over time, or do you need to generate income in the short term? Be specific about your timeline and the minimum amount of return you are looking for. It is also important to remember that dollar cost averaging should only be done with money that you can afford to lose. This is not a strategy for investing your emergency funds or safety net. Recession-proofing your portfolio. Only invest money that you would be comfortable losing in case the market takes a turn for the worse. Investing can be a great way to grow your wealth over time. Many well-known individuals have invested for many years and have made millions. However, it is not a guaranteed method for making money. There will always be risk associated with investing, and there is no assurance that using this method will result in profits. Before making any decisions, like with any investing decision, make sure you do your homework and consult with a financial expert. Thank you for watching. Please keep in mind that this video is just for informational purposes and does not provide financial advice. Remember, there are always risks when investing is involved. Please, before using any tactics, make sure to set goals and only spend money you can afford to lose. That's all for today's video. Hope you guys enjoyed our video. For more videos, make sure to subscribe to the channel and hit the bell icon for more interesting videos. Thanks for watching and have a wonderful day.